In today's show, we're going to talk about 2024 retirement, tax, and retirement planning changes that you need to be aware of. Also, we're going to talk about strategies to implement at the beginning of the year to help put your tax and retirement plan in the best position possible.
Welcome to the Your Life, Your Money podcast with Scott Searens, teaching you how to thrive in life, wealth, and retirement.
Welcome to the Retirement Show, all about your life, your money, and your taxes. I'm your host, Scott Searens. My goal is to help you thrive in life, wealth, and retirement. Thanks for joining the show, and welcome to 2024. I hope that you had a great holiday season. Christy and I had just an awesome holiday season. We got to spend a lot of time with family. We also got a chance just to take a break away, a little bit of vacation to recharge the batteries. So that way we're now ready. We're ready for 2024, and hopefully the same for you, whether it was time with family, time with friends, or a trip or some activities or some vacation. Hopefully just got to spend some time focusing on you, focusing on yourself, and recharging your batteries as well to get ready for 2024. And that's what today's show is all about, is 2024. Now, a few changes for 2024 is what we're going to start doing is also recording our podcast on YouTube, or I'll say on video, to be able to play on YouTube. So if you haven't checked out our YouTube channel yet, it continues to grow. We'd love to have you as a subscriber. You can go to lifemoneyshow.com and find our YouTube link there, or just go straight to YouTube and type in Searens Financial Group. That's SIERENS, and hit subscribe, as we're coming out with new videos each and every week on retirement topics like how to reduce your taxes, retirement income, Social Security. And then that way, if you subscribe, you'll get notified as those new videos come out. Plus the podcast. The podcast will now be on YouTube as well. So every other week in 2024, we're going to have a new podcast on different retirement topics as well. Now, not only will we be on YouTube, you'll still be able to find the podcast episode on your favorite podcast player. So if that's how you like to listen, feel free to subscribe there. You'll get notified when our new podcasts come out. But if you want additional retirement information, subscribe to our YouTube channel so you'll find us there as well. So those are some changes for us in 2024, and we hope that you enjoy the changes. We hope that you enjoy finding us, whether it's by audio or by video. We just hope that you enjoy finding us, the conversations with us, and the information that we provide helpful. And let's keep it going with that. Here's what I want to talk about today. I want to talk about 2024 and the retirement, tax, and retirement planning changes that you need to know for 2024. And then after we talk about the need to know changes, the other thing that I want to cover is the strategies, some retirement planning thoughts and strategies that while we're at the beginning of the year here, that you really want to think about putting in place for your future, for your 2024. Don't wait till the end of the year and think, oh man, I wish I would have, made those changes in January. Hopefully you'll listen to this podcast or this video and then go to your specific situation and make those updates or changes. So whether you're still working and within a few years of retirement, going to retire this year, or whether you're already retired, the thoughts and strategies that we're going to talk about today will impact and will have an effect on you and can potentially help you and your future finances in situation. So, all right, with that, let's start with the 2024 changes. What's new this year when it comes to retirement tax or retirement planning? One thing from a tax standpoint is they have increased. It's kind of like inflation on the standard deduction. So the standard deduction that you get from a tax standpoint has been increased. In 2023, if you're filing single, the standard deduction was $13,850. In 2024, that standard deduction is $14,600. In married filing jointly, the standard deduction was $27,700. Now for 2024, the standard deduction, it bumps up $29,700 for marrying filing jointly. In case you're wondering, listening to this, going, wait a second, how do I get that standard deduction? Well, guess what? It's standard. It's a deduction that you get on your taxes. So good news, it's going up. It's going to help you reduce your taxable income at the end of 2024. Now, some other changes for 2024 come to Social Security and Medicare. You should see that if you're receiving Social Security, you are going to get a bump, a cost of living adjustment, COLA is what they call that, on your Social Security. So your Social Security is going to go up by 3.2%. Great news there, right? More money in your pocket. However, guess what? Unfortunately, Medicare's actually going up as well. Medicare Part B, the standard amount that you pay, the base premium for anybody out there on Medicare Part B, that's going to go up by 6% as well. So you got a nice little bump on your Social Security, but guess what? They're going to take a little bit of it back away with that 6% increase on Medicare Part B. I'm going to pause right here for a second because I want to talk about Social Security. A common question that I get asked is, well, wait a second, should I go ahead and claim my Social Security right now so I get that 3.2% increase or bump on my Social Security? Guess what? If you're not taking Social Security, they're giving you that increase actually behind the scenes. So there's no reason to go out and specifically take it because of any COLA, cost of living adjustment, inflation raise that you hear about. You're also getting that incorporated into your Social Security behind the scenes. Okay, let's move forward. How about for those of you that are still working, some retirement plan updates for 2024. Now, if you're contributing to an IRA or to a Roth IRA, so IRA or Roth IRA, not 401k, IRA or Roth IRA, and you are under 50 years old, in 2023, you could contribute $6,500. Well, now that has bumped up to $7,000. So a $500 increase off of last year. And if you're age 50 or older, you can actually do those catch-up contributions. And starting in 2024, it's $8,000 that you can put in. Again, $500 increase on last year. Now, if you're working and your company has a company-sponsored retirement plan, those contribution limits also went up of how much you could put in those retirement plans. So let's talk about 401ks, 403bs, 457 plans. If you are less than 50 years old, you can put in $23,000 a year. Again, age 50 and older, you can make those catch-up contributions, and that's $30,500 a year that you can put into your 401k, 403b, 457. I should have said Roth 401k earlier too. All those Roth accounts, Roth 401k, Roth 403b, Roth 457, you can put the same amount into those accounts as well. So all based on your tax situation. We'll talk about that when we get to strategies for 2024. Then the other account where you got an increase of how much you can put in is the health savings account. So if you have a high deductible health plan, you can utilize the health savings account. Now, you've probably heard me talk about the health savings account before. I really, really like the health savings account because you get the tax deduction when you put the money in. It grows tax-free. You can actually invest that money to grow tax-free at a potentially higher rate than, normal savings account. And then as long as you use it for qualified medical expenses, you can withdraw it tax-free as well. So looking forward here, 2024, the year that we're in, as an individual, you can put in $4,150 for the year. As a family, if you're on a family plan, then you could put in $8,300 a year. Now, talk to your retirement plan, the company that you work for in regards to whether you would fall under individual or family. I'm guessing it's pretty straightforward. If your family's covered under your plan, you'd be family. But if you're an individual but married, but your spouse is on a whole different health plan, then you'd just be under the individual. So hopefully that helps you out in regards to that one. Now, a really cool change for 2024 is the company matches to your Roth 401k. Now, not every plan is going to necessarily offer this. It's all company specific and how quickly they want to take something like this on. But you see in 2024, with your Roth 401k, you might be able to make a switch that your company match also goes into the Roth side of your 401k. Now, how cool is that, right? You're paying tax today, and then once you get into that Roth 401k, your money's growing tax-free. But you see in the past, your company would make their contribution to your regular 401k. So that money would grow tax-deferred, and then you'd still have to pay tax on that money in the future. What a cool change, what a new cool rule. You can say, hey, company, I want you to make your match to the Roth side of my 401k or 403b or 457. Now, not only your money's growing tax-free and get to withdraw it tax-free in the future, their portion as well grows tax-free and you get to withdraw it tax-free in the future. So how cool is that? Great change. But again, all company, all plan specific. So you want to specifically check with your company to see if they're even offering it that way yet. And if they're not, well, maybe you want to start throwing them some elbows to see if you can get them to make those changes. And then the last change that I wanted to talk about here for 2024, before we go into some of those planning strategies, is the gift tax exclusion. So this is how much that you could gift to another person without having to file any sort of tax form. So if you're in retirement, heck, you might even be prior to retirement and you're looking to try to help somebody out, you're looking to try to maybe get money out of your estate, out of your tax burden, whatever it might be, and gifting it to somebody else, well, without filing any tax forms, you can now gift up to $18,000 per person without filing any sort of tax forms. Let's say you're single and you have 3 kids. You can give $18,000 to each child. Now let's say you're married and you have 3 kids. The one spouse can give $18,000 to each child, and then the second spouse could also give $18,000 to each child. And I was just using that as an example, but as you can see how you can utilize this rule now to gift to other people without filling out any sort of tax form. Now, remember, if you're going to take the money out of your IRA to gift it, you're going to have to pay tax on it. And you can't gift money in an IRA. So this is always money that is after tax money or taxable money. So there we go. I mean, there's more changes for 2024, but those are the ones that, to me, really have an impact on probably the people listening to this show that are focused on retirement or that are in retirement and planning for that. Now, how do we use these changes? And what are some things that we need to be thinking about at the beginning of the year here? The beginning of the year, so we can put our best foot forward for 2024 when it comes to your finances. Whether that means that it's for you to be able to retire this year or retire in 3 years, or if you're retired, you still want to put your best foot forward to make sure you're doing the right strategies at the beginning of the year to help reduce your long-term tax burden. And so let's talk about these different items here. Let me pull up my piece of paper and make sure that we're taking advantage of the time at the beginning of the year rather than waiting till December. We want to make sure that we're putting our best forward from a tax standpoint and a retirement standpoint. Okay. Here we go. I've got, let's see, 1, 2, 3, 4, 5, 6, 7, 8 items to go through here. So stick with me. Like I said, whether you're pre-retirement or retired, they're all in here for you to make sure you're putting your best foot forward. Okay, so the first one is, are you putting your money into the right bucket? 401k versus Roth 401k versus a taxable account, or IRA versus Roth IRA versus a taxable account. Now is the best time to reevaluate your situation. You see, this is something that we do at the end of each year for all of our clients in our year-end tax planning meeting. So that way, as they go into 2024, they know which accounts they should be putting their money into to put themselves in the best tax position possible for their future. So just to quickly recap these, a 401k or an IRA, you get a tax deduction today, grows tax-deferred, but you're going to have to pay taxes on all of that money in your future. Roth, pay tax today, grows tax-free income in your future. The taxable account, well, yes, you pay tax today, and then depending on how you manage that, you could or you may or may not have taxes on interest, dividends, and gains. So now is a good time to reevaluate your situation. Where do you see your taxes to potentially be this year? Where do you potentially see your taxes to be next year? Where do you potentially see your taxes to be in your 70s or your 80s or your 90s based on required minimum distributions? And then based all of that, should you be putting your money into a different bucket? And now's the time to make the change, because again, if you wait till December, well, now you're just on to next year. So now's the time to make that change. The other reason it's always good to think about this is because of tax diversification. Are you tax diversified? Meaning, if all your money is in 401ks, then guess what? If you need money in the future, One, if you're not age 59 and a half, you're going to have to pay that early withdrawal penalty of 10%. Now, there's some exclusions to that, but in addition to that, every dollar that you take out of whether it's a 401k or an IRA, you're going to have to pay taxes on that money. So do you have your money in different tax buckets? So if you need to make withdrawals in the future, you can, no problem. And you're keeping yourself tax diversified. You're able to now manage your tax brackets no matter which direction they go. The other good reason to think about this, think about your 401k contributions or your Roth 401k contributions at the beginning of the year, is it's a good time to reevaluate to make sure that the percentage that you're putting in is helping you max out your contributions. So I just mentioned all of the contribution amounts went up by $500. Now, if you're somebody that's putting in a percentage base, then you might already be maxing it out. But if you're somebody that's doing a dollar amount base, now's the time to make those updates, make those switches, because that way, as they take the money out of your paycheck, those contributions out of your paycheck, they're taking the new values out. So you have that increased $500 going into your 401k or your Roth 401k. The last thing to really think about as we go through this, and I talked about it in some of the changes, is does your company offer the match to the Roth side of your 401k? If so, is that in your best interest? And if it is, do you want to make them switch to make their contributions go over to the Roth portion of your 401k? So that's number one, is reevaluating your tax deferred versus tax free versus taxable contributions and making sure you're putting the money into the right amount. Okay, number two here is if you switched to a high deductible health plan, make sure that you're starting your HSA contributions. I mean, if you switch to the high deductible health plan, make sure you're getting the benefit of that health savings account, the money that's going to grow, again, get you a tax deduction. It's going to grow tax-free. And as long as you use it for those qualified medical expenses, you can use it tax-free as well. I would almost put this as a priority higher than putting money into your 401k just because of the triple tax benefits of this account. So if you switched over, or even if you already have the high deductible health plan, are you putting money into your HSA? Are you maxing it out? And then the last part is your HSA invested? Remember, you can get tax-free growth on that money. So if you need it right away, maybe not the best reason to invest it. But if you're not going to use it for 5, 10, 15, 20 years from now, we'll get that money invested and growing for you. All right, let's keep it going here. Number 3, now is also a great time to review your investments. It's a really good time at the beginning of the year to make sure 2 things regarding your investments. One, it's a good time to rebalance your accounts. At the beginning of each year, we take the opportunity to review all of our clients' accounts and rebalance when and where necessary. So for example, last year was a great year for U.S. equities. Let's say you had some bonds and some U.S. equities in your account. Well, your U.S. equities may have went way higher than what you already originally had. Maybe you wanted 65% in U.S. equities or 60% or 70% or 80%. Well, based on all of the growth last year, your U.S. equities might have grown outside of the tolerance that you wanted them to be at in your overall portfolio. So now is a good time to sell high and buy low of something else. Get your pie rebalanced in regards to your investment plan. The other good thing to do is reallocate. Now, what do I mean by this? Well, depending on where you're at in life, you might need to start making some shifts from the growth or equity side of your portfolio over to that safer side, that what I've nicknamed the war chest portion of your portfolio, a pool of funds that's not subject to the same volatility as the growth side, that will be there to utilize for income in case we have a market crash on the growth side of your portfolio. So now is a good time to reevaluate and reallocate any funds that need to be shifted over. Every March with our clients in our strategy meetings, this is exactly what we're doing. We're looking at their income plan. We're seeing what they're going to need for income from their investments for the next 5 years. At least 5 years, everybody's different. Sometimes people want more over in their war chest. And then we're making sure that we've got that in the war chest portion of the portfolio. And then we've got our growth portion of the portfolio as well. So from an investment standpoint, take a look. Should you be rebalancing and should you be reallocating? All right, for those that are retired, heck, actually, if you're still working, this could apply to you as well, is should you be considering qualified charitable distributions, QCDs? Now, you might be thinking, wait a second, Scott talked to this as a year-end planning item, and it's kind of both. And here's the reason why, is because I also want you to think about QCDs at the beginning of the year, because I want you to think about if you have to take required minimum distributions, RMDs, I would really suggest that you take your QCDs before you take all of your RMDs, especially if you're not going to spend or utilize all of your RMDs. You want to do the qualified charitable distributions first. Okay, that's kind of something that's going to help you from a tax standpoint. So let's stick on the tax standpoint thing. What's something else, a thought strategy that you can be doing right now at the beginning of the year to help put yourself in the best position possible by the end of the year? And it's reevaluating your tax withholdings or updating your tax withholdings. So if you're doing your taxes and you're seeing that you're going to get a big refund, I know it feels great, but guess what that big refund is? It's just a free loan that you've given to the IRS. And instead, you could be putting that money in your pocket instead of getting it next April. So the beginning of the year is always a good time to reach out to companies and go, you know what? It looks like I'm going to get a big refund. I should be lowering my tax withholdings and be putting more in my pocket throughout the year versus giving it to the IRS. Or maybe you owe the IRS each and every year. And if you do, now's the good time to reevaluate as well. And rather than get a tax surprise next April, what you want to do is start paying in more taxes, have more withheld from the withdrawals that you're making from your company paycheck. Or maybe what you need to start doing is make quarterly payments in. So two parts. One, we don't want to give the government a free loan. And then the second part is we just don't want you having any sort of underpayment penalties for not paying enough into the IRS. This is where those year-end tax planning meetings really come into play. Again, that's something that we did in October. We evaluated the situation not only for last year, but also for 2024. And we said, hey, here's some updates that we suggest for 2024. So if you didn't do a tax planning meeting the end of last year, then now is a good time just to sit down, look at your situation, maybe hurry up and get all your tax stuff ready to file so you can see where you might be. And then you'll still have like February, March, April, May, throughout the rest of the year to update your situation. But if you already know, don't forget, go through and make those updates. All right, we've got two more strategies that you might want to think about updating in 2024 or utilizing in 2024. And one is automation. What do I mean by this? Well, if you're someone that's working, collecting an income, and you always get to the end of the year and you're like, gosh, I wish I would have saved more, or I should have saved more, or I got to the end of the year and there wasn't money there to save more. Or now it's all sitting in our savings account, but I wish I would have gotten it into the Roth before the end of last year. Here's the thing. Automate, automate, automate. You've heard me talk about automation before. One of the things that you can do is just set up automatic contributions to your accounts. So that way the money's taken out of your savings each and every month, or out of your paycheck, or out of whatever it is, and goes in to whatever you want it to go into. This is a great way, if you're in those last few years, to make sure that you're maximizing any sort of contributions that you can to those tax-deferred accounts or tax-free accounts or even the taxable accounts. Automate, automate, automate. Once you start doing this, you're going to just figure out how to live your lifestyle and what's left coming in. And then you're going to be really happy with your future self, because you're going to say, wow, look at all that money that I've saved up that now I can utilize for our retirement, for travel, for whatever it is that you're hoping to do in your retirement story. You're going to have it there for your future if you automate. So go ahead and think about that. What should you be automating this year so it's automatically going into your savings? And if you're already in retirement, a few things that you can automate as well. Maybe it's those tax withholdings. Maybe it's your monthly paycheck that's coming out from your retirement accounts. Automate that as well. Get yourself back into the groove of living that lifestyle like you've got a company paycheck coming in again. So automation, think about that. And then the final thing to maybe put into your New Year's resolution is getting that plan in place. I understand life gets busy, retirement gets busy, work gets busy, the New Year's gets busy. You're going right back to work. You're getting right back into the grind. And you're going, gosh, I really hope I'm on track to retire next year. I really hope I'm on track to retire in 3 years. I really hope I can take the money out that I think that I can take out this year. Instead of hope, get a plan in place. Take this year to make that one resolution to get the plan in place, because with that plan in place, guess what? If you find the right person, they're going to help you put in all of the other actions that you need to do. So if you're listening to this going, wow, that sounds like it's really overwhelming, then just work with somebody to get a plan in place. If you're wondering if we're the right fit for you, you can go to lifemoneyshow.com. You can click on the Work With Us tab. Everybody's got somebody that will be the right fit for them. Now, if you're a do-it-yourselfer, great. Hopefully you're going through today and saying, okay, I'm going to make sure I do all these things. But if you're not, if this isn't something that you like to do, it's not something you focus on, you don't look at your investments to reallocate them or even know how to reallocate them or rebalance them, then maybe it's time to get something in place, because putting the right type of plan in place, it's going to help you understand when you can retire. It's going to help you understand that it's okay to retire. It's going to help you understand how much you can spend in retirement. It's going to help you understand ways and strategies to reduce the taxes on your 401ks, IRAs, 403bs. It's going to help you understand how to maximize your retirement story. So there's my cap to the finale to the 2024 kickoff show here is, if you've been thinking about it for a while, maybe now's the time. Get yourself a retirement and financial plan in place. Hey, hope you enjoyed listening to the show. If you love listening on audio, well, subscribe to your favorite podcast player. And if you like seeing things in video or just listening on YouTube, subscribe on YouTube. You can check us out at Sierens Financial Group. That's SIERENS. Sierens Financial Group. Hit subscribe so that way you're getting notified either way, podcast player or YouTube, when we've got new videos, new podcasts coming out each and every week. Thanks and have a great day.
Insurance products are offered through the insurance business Sierens Financial Management, Inc. Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.